For the first 3 quarters of this year, what was really driving the Treasury market was inflation expectations, and essentially how far and how high the Fed would have to go in terms of raising their rates in order to stem that. Now, we recently had a downside beat to CPI. That shifts the market's focus a little bit away from inflation and towards growth. Most recently, we had a big upside print in retail sales, and you saw the market bullishly flatten, which to me suggests that we sort of have this increased likelihood of a hard landing due to the fact that the Fed will have to keep raising interest rates. The Treasury market has been very reactive to what the committee members are telling us. This Fed regime, in my opinion, has really tried to emphasize their ability to talk in or talk down monetary policy in the weeks leading up to a meeting. And then Chair Powell typically will come and either underscore or talk back some of what the previous rhetoric was about. This regime, in my opinion, is loath to increase volatility on days of the actual event. So what I think a step down would look like would be increased rhetoric for some of the core committee members, signaling that 75 basis point hikes are no longer necessary. Those are considered an emergency. Now is a time where we're moving towards 50 and then potentially down towards 25 in some of the following meetings. So what I anticipate one of the primary ramifications in a Fed step down to the Treasury market functioning really has to do with liquidity returning to the market. Part of the reason why liquidity has really disappeared, in my opinion, over the past 6 months is due to the heightened uncertainty about how much the Fed will go and when they'll go, and in all honesty, how high they'll go. And what a step down can bring us is some degree of certainty over the very near term about what the Fed will do. And that should bring back risk takers into the market in a size that we really haven't seen in this hiking regime. In my opinion, I think that one of the effects of Chair Powell shifting the market's focus from very near-term, one-off data releases towards a string or a trend of data releases that we've seen in the Treasury market so far is near-term volatility has compressed, while longer-term volatility has remained fairly stable. When I say volatility, I mean implied volatility within the Treasury market. And so what that says to me is the market no longer is pricing a premium on near-term moves and rather sees both the near-term and the medium-term future roughly equivalent in terms of uncertainty.